Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, Ava Benesocky, and I'm joined by my co-host, August Biniaz. We have another great show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Our mission is to empower investors to earn passive income through real estate investing. We're real excited today because we are joined by Brice Scheschuk. Brice, CPA, managing partner of Globalive Capital. He was a co-founder and CFO of Win Mobile, as well as CEO of Globalive Communications. Brice has over 25 years experience building and operating companies at Globalive, Win Mobile, LaItch Technology, and PricewaterhouseCoopers. He has obtained his CPA CA designation at PricewaterhouseCoopers and BCom Finance from Dalhousie University. Brice served as Marine Surface Officer in the Royal Canadian Naval Reserve. So we believe this interview with Brice will bring great value to anyone looking to learn about the fundamentals of personal finance, which are the foundations of wealth building strategies. And furthermore, this interview will bring value to anyone looking to start or scale their company. So thanks for being here today, Brice. Welcome.
Welcome, Brice.
Thanks very much for having me, both of you. Really delighted to be here. Perfect pronunciation of the last name. And just a heads up that there might still be a little lag, but let's go with it and see how it goes, okay?
Fantastic. Awesome. Okay, great. Now let's start off with financial literacy. What is financial literacy? And share with us the basics that anyone can use in their daily lives, please.
Okay, great question. So the classical definition of financial literacy is the ability to use knowledge and skills to manage financial resources for a lifetime of financial well-being. That's an easy kind of sentence, but there is so much in it that one has to consider societally, individually, and just generally how we are doing and how we educate people and how we think about this to move through what is one of the foundational issues through our lives and through society. The act of creating wealth, the act of buying your house, the act of accumulating investment assets such that in future you can retire, decumulate, live a comfortable life, have the insurance to protect yourself, pass along to the next generation, and all the complexity therein. And for whatever reason, and there's probably many, we have not prioritized financial literacy, in my experience, in our education systems almost across the board, both in Canada and globally. And I think we've done ourselves a very big disservice as a society therein. And I know these types of things, what we're doing today, are examples of trying to move the ball forward on it. And I think we're seeing a lot of other resources coming because it is well recognized. What I say to people about that is, the first comment is you need to take ownership of your financial well-being. You do not want to rely on others. You do not want to rely on government and social support. You want to own it, and you can own it, and you have an opportunity to do that. And I think that's critical. The last thing that I'll say about this is there are some basic categories of financial literacy. It can be daunting when you're not maybe a math person or you haven't done a lot of business and finance in your life. It can be daunting, but quite frankly, the complexity of it is often done by an industry that benefits from complexity. And I say to people, the goal is to simplify. And if I could simplify quickly, think of it as how much you earn, the whole side of income, the job that you pick, the passion, the talent that you have, your income earning potential, looking forward to the best industries, less you're spending. So being smart about how you spend equals ideally a positive savings. That savings balance can be invested. That investment can compound. That compounding generates more and more wealth on top of itself. And then you eventually reach a state of what we call rich, which means freedom.
Great, thank you for that.
Amazing, thank you for that, Brice. Next question, let's discuss income and expense ratio, with the difference being savings. So how can people increase their savings, and does increasing savings equal creating wealth?
Okay, yeah, great question. So, income, expense, net, positive, negative. So here's what I would say. So the income side is a more long-term thinking approach. Where do you pursue earning potential. And typically how we break that up is we talk about a mix of where's your passion, where's your talent and skills, and where can you have economic opportunity. We look at it as a bit of a triangle. And you want all, the easy example that I always use is a good buddy of mine is a football, soccer fanatic. And he recognizes that he doesn't have the talent or the economic earning potential to be a professional soccer player. It's an obvious kind of simplified example. So you kind of want to get all three to work in sequence. I like to use some terms like skate to where the puck is. So we know what's happening in society with the innovation and technology economy. We hear words like AI, Web3, self-driving cars. We look at Google, we look at Microsoft, we look at these companies and the wealth creation that's coming there. Those are great areas to look forward on when you think about your education, your earning potential, and where to think forward. If I go to the spending side, the simple rule is be careful when you move the goalposts. And what we mean by that is very simple. There's a tendency when you add income to add burn, to add spending, and often it's not well managed. As one is going up, the other is going up, and you create a burn rate dependency that if anything happens on the income side, you have a real problem with maintaining your spend, and or you're missing savings opportunities by just doing some very basic things like substitution and so on. So income, spend, you then mentioned kind of, is that net, if it's positive, wealth creation? It is the start of wealth creation.
Right.
Okay, so you are creating something positive, and then you need to then exercise it to the next phase, which is obviously earning a return passively on that net positive savings.
Very well said. Awesome. Now, I wanted to talk about this concept you speak about, which is the balance between smart investing and then depriving yourself from life's pleasures. So how can this, perfect balance be achieved? Let's talk about that, because I really love this topic.
Yeah, so perfection is always difficult, but I like where you're going. I can give some directional examples. And here, the one I use commonly is a silly example, but I think it's super illustrative. So, and this is a true example. I've been lucky in life where I've had good employment and then have started businesses that have done reasonably well in the world. So I've never been one who has to be super sensitive to spend. Okay. And I found, an era where my wife and I would go, and the example I use is we would go to Starbucks twice a day each, every day of the year for probably a decade. Okay. Now, just twice a day. So 2 coffees a day, Americanos, lattes, all that kind of stuff. Now let's just do some basic math. Starbucks, you almost can't get out of there anymore without a $5 coffee. Okay. Yeah. You do 4 of those a day across 2 of us, $20 a day, 365 days a year, weekends, you name it, a little over $7,000 spent a year. Okay. Now, what I have actually realized is, so I went and bought a very nice, machine to substitute for Starbucks, gave me control of the beans, gave me more control over what I actually wanted, the convenience of having it at home. And I cut my spend on an amortized basis, from a little over 7,000 to about $400 a year. Okay. So stupid example, but 7,000 to 400, that $6,600 has now turned into an inflow to me that comes within an overall cash flow framework that can then start being invested. And if I could show you the example, this is probably when I was 23, 24 that this started. If I could have those 10, 15 years back of doing that, take that money and have compounded it by investing smartly, we would all fall off our chair at how much money was left on the table. So there's a few points to kind of reiterate in that. Number one, don't deprive. I have a better situation now than I used to with that Starbucks example. Number two is find smart substitutes, worry a little less about the status, and splurge every once in a while when you have to, but watch that recurring behavior. Right. And again, once you start doing just a little bit of math on compounding and what that could mean for you from an investment standpoint, it becomes so addictive to actually change your behaviors a little bit to act on that compounding opportunity. So that's how I would explain it.
Incredible. And anybody listening, compounding, research it because it's a game changer, like Brice mentioned. So research that word and really familiarize yourself with it and go after that compounding.
And we've seen some of your past presentations where you actually show a slide where it shows, hey, do you rather have $1 million today,
Yes.
or do you rather have I believe $1?
A penny a month.
No, a penny it's not a month. It's a day. It's a day doubled.
That's right.
Oh, day doubled.
A penny it doubled per day, and then within a year, I believe it.
No, it's way more powerful than that. So I'll give you the quick example.
Yeah,
so the first illustration of compounding is: would you rather have $1 million right now, or a penny a day that doubles every day for 30 days? And what you will find is that you will have over 5 million. So penny becomes 2 cents, becomes 4 cents, becomes 8 cents, becomes, so on. In 30 days, that'll be over $5 million. That is obviously the silly, it looked kind of like my Starbucks example, although sadly my Starbucks example is true. That is the kind of the silly illustration of compounding. What I find actually far more interesting is that if you can remember how you said, what is that wealth creation? If you can get that $1,000 of net wealth creation working for you very quickly at a young age, in some of these new product ETFs, some of these low fee products that you just set it and forget it, and you leave it. If you're 15 years old when you start it versus 20 versus 30, like the power at the back end of starting earlier is unparalleled. And so your comment about learning about compounding is one of the, call it 5 or 6 core principles that I would espouse. And the concept added to just learning about compounding is getting it put away, not thought about, and left for 30, 40, and 50 years.
Incredible. And it's cool to show 15-year-old the numbers so that they can get excited about it and really start understanding at a young age. Because as you said, the younger you start, the more you put yourself in a better position. I love what you said there. You're like, you talked about your Starbucks with your wife, and you said, okay, we saved, $6,200 or $6,400 or something a year. And you said, I could take that now and start investing. So the next topic, let's discuss investing. Should everyone invest? Or is investing reserved for a selected few? And I want to give an example. For an example, our investments here at CPI, they're reserved for only accredited investors. Now, this makes up 95%.
No, it makes 95% of
This makes 95% of the Canadian population, and then 90% of the US population and eligible to invest with us. So maybe please talk to us about investing and if it's the right strategy for everyone.
Okay, so great framing. I think let's put the concept of accredited, unaccredited a little towards the end of this. It is a super important concept to talk about. Okay, but let's start with just the common populace, regardless of your station, accredited or unaccredited. The answer is a resounding yes. Everyone should invest. Okay, so let's start there. Now, one can't be so blanket without some caveats. Okay, caveat one is there's an exercise in life typically of incurring debt. I encourage debt incurrence only in 2 cases: the act of certain targeted student loans for an investment in yourself, being education, and there's a caveat to that. And then second is for the purchase of housing in economies where the stock of housing makes sense to buy, own, and it actually becomes its own kind of store of wealth, for lack of a better way to say it. So when you've incurred debt, there's a debt servicing cost to that, which means that the act of having positive net savings, you have a choice to pay down debt or to invest. And that can be, we won't cover it in here in any level of detail, but that is something that adds to the investment equation. And look, the act of paying down debt for those types of things is a form of investing. But if we then move solely to the act of investing, so again, let's pick that easy example. Okay, if you can get $1,000 socked away in let's use a very low fee digital brokerage account example. Now pick a Wealthsimple, pick 100 others, an online brokerage, a Questrade or whatever in Canada, Robinhood in the US, and a million others. If you can get $1,000 moving into there using North American numbers, not third world or developing nation, and these are relevant, by the way, to them as well, just on a divisible basis. If you can move money in there, again, set it and forget it. Meanwhile, on the other side, your income and your spending are being managed to create that small positive net savings. You size your lifestyle accordingly, getting that number working as early as possible in, let's just pick something, a global equity ETF that gives you perfect diversification from Vanguard in one purchase at almost zero fee. And you just go away for 50 years and there's an auto move from your bank account every month, $83 to get to $1,000 a year, and then it just builds. I personally believe that everyone should do that. Now, I will put a caveat. I am not, I understand that we have some social challenges. Okay, I understand that there are some deep poverty issues and so on. And so there are circumstances that obviously one is in a different set, a small percentage of the population is in a very difficult set of circumstances. That's a social discussion that I'm not trying to cover here.
But at least they should have the choice. At least they should know that the option exists and the
Yep. Exactly. And so what does all of that mean? Well, I'll tell you here's what I think. The discipline of that creates a better earning spending situation. So you're not spending, you're not always behind. That the act of the mindset of that, I think, is super powerful. Obviously, the act of compounding we've talked about, and early time working in your favor. And then the other thing is it forces you, once you start down that road, of getting educated on the topics. And because the education system doesn't teach us effectively about financial literacy, I think they're trying, but they haven't really done a good job at it. It actually forces you to get yourself educated as early as possible in some of the basics, which is such a critical lifelong skill. So that's the mass comment I would make. Okay. And it's incredible for any middle-class person. Once they really do like a basic budget and look at their earnings and spending, even kids with summer jobs, the examples I've used in other presentations, they are smart savers. They're living at home. They don't have the same overheads. Start it. And you won't believe the discipline. Now let's move to accredited, unaccredited. So here's what I would say. It's sad. There was a reason why they put the unaccredited, accredited rules in place. The regulators thought that they were protecting the common population from people selling investment products that were either unsavory or were too complicated for them to understand. I think that the entire regime of accredited and unaccredited should be revisited. I think there's a lot of thinking. You've seen the crowdsource, the crowdfunding rules, allowing it to now be reached out to an unaccredited. I think there should be more and more allowance for unaccredited investing into more probably alternative and private and so on related products. I think it's a disservice and a very wide miss to wealth generating opportunities. But again, we'll leave that for a moment. So the comment I would make to you is all should invest, barring a few social comments. Unaccrediteds, absolutely, done in a way that works within the system, as low fee as possible, as technologically forward as possible. That phone we all have in our hands is the greatest thing ever from an investing and information standpoint. And obviously, if you're accredited, we start getting a little more complicated and sophisticated, but the fundamentals do not change.
Well said. Well said.
Well said. Now, Brice, what is the definition of being rich?
Yeah, you're teeing me up perfectly here. So my definition of being rich, this took me a while. I'm 50. You guys are younger than I am. I know that. I had the status issues when I was younger. I was making okay money and trying to have the car and trying to have the polo shirts and all that kind of stuff. You know what you realize when you get a little older and you can reflect what really means something. And so my definition of rich, which I think is well trodden, is freedom. What is my definition of freedom? Unfettered control of time. Time is our most precious resource, right? You start doing the every minute, every hour, every week, every month, every year, you calculate how much you've got and how much you've got to be productive, but also to have fun. And the number is sadly, like, I can't believe I went from 25 to 50 and I don't know how that happened. Yeah. So time is the win. And then control of time is achieved. So it all plays in a hierarchy. Control of time is achieved when passive income, so the income from you not having to lift a finger to do anything, is greater than your spend. goalposts sized accordingly. That is my definition of freedom, of rich, sorry.
Rich.
Amazing.
Amazing. And I know that as, you know, when I was a little girl, my dad would always say, you know, as you get older, time goes by faster and faster. I never believed him, but as I'm getting older, the value of time, it's just in a blink of an eye, you know, just the days are going by. So very well said. Thanks for sharing that.
And that's a wise father right there.
Yes, absolutely. Now I want to switch the conversation a little bit here to building companies from the ground up. So Brice, we know that you've been part of, you know, you've built some great companies. So please answer this question for me. Does a great company start with an idea or a team?
Yeah, perfect question. In fact, the short answer is it's usually a little combo of both, but much more team. Okay. And there are tropes that people talk about: 10% idea, 90% execution. 10% strategy, 90% execution. Team and talent are always the number one criteria, particularly in the formation stage. Okay. And so, yes, that's the answer. And what I will say to you, here's the thing that people get wrong. There is this view that I don't have good ideas on how to start a business. I haven't had the aha moment. The light bulb never went off in the shower when I was thinking about, my future and so on. And the reality is it never works that way. Okay. What happens is that you live, you work, you do whatever, and you start seeing problems that people are having, businesses, customers, consumers, whatever it is. And those who succeed recognize that there's a problem to be solved. And then they very methodically start going about picking it apart, talking to people about the problem from the customer's perspective. And then they start this flywheel of business building that iterates continuously to solve that problem better, faster, and stronger than whatever came before it. And it is not, I sat in the shower and suddenly, Moses came to me with the 10 commandments. And commandment number 1 is thou shalt build a new form of rocket that travels supersonic in the world. So it's much more a exertion, business building exercise focused on the customer, finding the problem, not creating a solution, looking for a problem.
That is so incredible that you can see us smiling over here, right? Because our company was literally built of a problem that we've seen existed, and we found a solution to that problem. So just you saying that, we have big smiles on our face over here because we can relate to that exact statement. And you totally are correct in saying that.
Finding a solution to the problem and realizing there isn't a lot of people offering the services for that solution. And the problem was real estate prices being so high in Vancouver and Toronto, the main cities in Canada, where most people can't, they're told all the time, invest in real estate, but with medium income being 90,000 approximately and medium home price being 1 million to 1.2 million, most people have a difficult time buying their primary resident. Maybe in some cases they can't even buy a rental property, but to scale as real estate investors is difficult. So to allow these alternative investments that CPI provides is something that we feel like we solved a problem.
You found a solution to a problem.
Yes.
Real exciting.
And it's interesting because again, when we talk about, I know we're not going to get into the detail of asset allocation and security selection, but when you start talking about it, again, back to your comment around the accredited, unaccredited. So we believe that real estate is a cornerstone asset for all portfolios that for all portfolios, let's call it generically. And when we do our investing, we have a very targeted asset allocation to real estate. And thankfully we are accredited. So we have a relatively sophisticated way of looking at how then to deploy within that category smartly. And what I hope happens, partly for your sake, but also for the world, is that these accredited, unaccredited rule changes happen whereby, I'm the person saving 10 grand a year compounding, and I can go to you guys and do a $1,000 allocation or whatever makes the most sense in that context. And I get a nice diversified portfolio of fractionalized ownership in real estate in whatever category within that kind of narrative. So you are finding a problem that exists. You are providing a solution. And I hope, quote unquote, your addressable market gets a lot wider as the regulators get a lot smarter.
Absolutely. That would be incredible. Now, we at CPI Capital, we've built a real estate private equity from the ground up, literally. And now that our company is growing, we're having discussions internally, and we're contemplating to either hire or bring on partners. What is a better route, in your opinion?
To hire or bring on part. And when you say bring on versus hiring, do you mean more on a consultative basis, like under contract, or how are you thinking about that?
No, I actually like giving up a piece of the company to bring in a partner
Yeah.
where we don't have to then pay a salary and hire the great minds we want to hire, but rather bringing on a partner to give up a portion of our company, I think is a struggle that a lot of newer companies go through in early stages.
Yeah, great question. So the short on it is what we see in the let's call it the generally innovation, technology forward, those kinds of organizations that are really thinking of, I'm not talking, and again, no, not trying to denigrate, but not the Subway franchisee who needs to bring on some counter staff. You're talking about bringing in talent that is a player talent that's going to help drive your business forward and create wealth for everyone.
Yes.
Okay, so in those scenarios, if that's what we are talking about, unequivocally, if you look at the market now, we are in a complete and utter war. You've heard the term war for talent. You've heard the term the great resignation. You've heard terms like people really being able to take a step back because of the pandemic and think about what it is they want out of life and work. And it's changing the nature of work. And that has actually, I would suggest, exacerbated what was already a trend in innovation forward companies, whereby equity is almost a must. Okay, and equity means a few different things. So we should just drill on that for a minute. There is an employee where you bring them on, they're a player talent, you're going to pay them a salary because they do need to live, and you're going to issue them maybe some stock options as an equity incentive that vests over time to have them invested in the business, thinking about the company every day and really charging forward, knowing that wealth creation is happening beyond just the salary that they're getting. That is one form of equity. The other form is you're actually probably looking for a partner that would be a little more established. They would have wealth and they would have interest and skill in what you're doing. And they would say, you know what, guys, okay, I want to buy 20% of your company, set a value. I'm going to put money in. And one of your asks is, I want you to come in as an advisor, as a board member. I mean, going to the extreme of employment is not unknown. It's maybe a little less practical when they're very wealthy, who could afford to buy in. And then it's like, we want to build this thing together and figure it out. So if I could summarize, again, just to try to shorten the conclusion here, there is equity, employee style equity incentive, which I think is a necessity in nimble, small, innovation forward companies to get a talent. And there is the act of selling a part of your company for cash that then turns into what is the relationship you will have with that capital provider as an advisor, as a management team member, as a co-founder, as a board member that helps you propel the business forward. That's generally how I look at it.
Great.
Okay, very cool. I like those two different options. Great. Now that leads to the next question. Who should be the first person a company hires? And this is obviously aside from the original founders.
Yeah, so great question. Now, again, very generalized, so it's hard to answer it perfectly. I can tell you the personas and I can tell you what I generally see, okay? So that when we think about innovation, we break it into three personas of people in a company. One is the builder, so call it the product, the technology, that whole world of creation. Number two is the seller. So that person what we all know, who's a networker, who goes out and talks to the customer, who's talking to partners, who's always kind of drumming up the next thing, that kind of outgoing type personality. And then we call it the measurer, which is more that finance operations, make sure the donuts are made every morning and everything is working on time. What I typically see is that well, actually, you know what? It's too hard to generalize. But I would say to you, finding out where your weaknesses are as a founding team is often where I look to fill first. Okay, and I'll give you an example. In technology, what we see a lot is very technical teams come together, a bunch of very smart engineers, and they have this problem that they're solving, and they start building a product, and then they need to think about customers. And none of them know how to sell, none of them know how to talk to customers, all that kind of stuff. Very frequently in there, a very early hire is what they would call a go-to-market, a chief revenue officer, a sales, a marketing, whatever that world is. You can also see the flip, where you have some great salespeople that come together. They don't know how to build technology, and they need a tech hire to come in and do that. So it's understanding the personas, understanding the competencies of the founder group, seeing where your weaknesses are, and what adds the most enterprise value in the most logical and prioritized way. That's how I think about people.
Perfect. Perfect. All right. Should I do this question? Sure. So, kind of switching the topic here a bit, but let's discuss being a mentor. I believe there's a famous quote that a great person needs to have a mentor and a protege simultaneously. Do you mentor, and do you mentor others? I mean to say, and do you have a mentor?
Yeah, great question. So not only do I believe in what you said, we have actually gone to the level of starting a not-for-profit that focuses on the art and craft of mentoring and menteeing. So being an effective mentor and being an effective mentee, because we have found in the world, there's been a lot of mistakes made that actually set people back as opposed to advancing them forward, which is what the point of mentorship is. So I could go for hours on how important it is for a person to seek out mentors and coaches, to not make, to make less mistakes than the ones who went before them. You hear the terms about standing on the shoulders of those who went before you. There are countless numbers of people that want to mentor, and they want to take the knowledge and help people draw insights out of their future and so on. It's an endless topic. 100% do I support it. I mentor super actively across tons of tech accelerators, across our portfolio founders, and so on. On the mentee side, on the active mentoring, what I will say is that I say to people, the active mentoring, so having a protege, makes you a better human, makes you a better leader, and makes you think a little bit differently about how you interact, and makes you a better person. And I have found that personally. It's actually shaped me differently since I've actively started to pursue this. So yes, on both sides, I believe in mentoring, and I am always learning. For those who are kind of continuous learning or growth people, you want to have mentors. And so yes, on both. And mentors, by the way, can be peers. They can be subordinates in the corporate hierarchy. They can be younger people who are working on crypto and blockchain every day of their lives that I want to become educated on. So it is not what you think, where the older person mentors the younger, It can take all shapes and sizes as long as you're open to it. That's kind of how I think about mentorship.
I think that question was strategically put into place so Ava can ask you on live recording if you would be her mentor.
Well, you know what? I have to eat my own cooking. So I commit to you guys that I will definitely give you some time outside of here to mentor on your business building. Okay.
Wonderful. That's super exciting to hear, Brice. That made my day. All right. What is your next question? What is your advice to passive investors looking to start investing in real estate private equity?
Okay. So looking to start.
Yeah.
Well, okay. I mean, to start investing in real estate, there's that accredited, unaccredited. Let's assume they're accredited. Okay, so we at least get past that hurdle. Okay, the starting point, I think, for real estate investing is interesting because we all touch it usually by virtue of homeownership, right? So if you're accredited and you're thinking about investing in real estate, I'm going to make an assumption that you probably own a home. So you're starting to actually accumulate a store of wealth. Again, we can debate. A lot of people talk about your primary residence is not really an investment. It's more of a, it's a personal use situation, but I do think it is in a way a store of wealth, which means there's an investment concept to it. So you already have started likely. Okay. And that's usually a private property, blah, blah, blah. I think that there is value to public REIT investing plausibly to start your real estate journey. It gets you to learn about the sectors of real estate. All the asset categories are industrial, retail, residential, commercial, office, industrial, digital, all that digital infrastructure, data center, towers, fiber, so on. And you start getting educated across the board. Okay. Then you're deploying. So you've got security selection and all that kind of stuff that's going on. And you're learning and you're learning and you're learning. And as you're doing that, there is then a way to enhance, in my view, that whole process by seeking out private alternatives. Okay. And we are very active investors in private in places that we couldn't get exposure to by virtue of the public REIT markets. Condo development would be one example, and there's a million others.
Right.
So I would, if I could go along the continuum, primary residence, get your house, you're accredited. 2 is the public side, to just understand the asset category and get some smaller amounts at play and a bit of diversification. Maybe an ETF or 2 if you want to go in the structured product world. And then you're going to find the holes. And where those holes are, you then start seeking out, people like you, managers who've created product that is available at whatever size, scale, asset categories that you want to diversify into. Build the trusted relationships, do your due diligence, and then start to deploy capital. That's kind of how we did it on our side.
Amazing,
Nice.
amazing. And we've asked the same question from people who are only focused in real estate private equity, and feels like Brice's answer was more sophisticated than lots of other guests. No insult to our other guests, but
Oh no, yeah.
great,
Absolutely.
amazing. So the next segment of our show, thank you for all that. I'm sure our viewers and listeners, gained a lot of golden nuggets and the knowledge from that. And great. So let's start the rapid fire.
The 10 championship rounds to financial freedom.
All right. I'll do my best here.
Awesome. Whatever comes top of mind. Okay. Here's the first question. Who was the most influential person in your life?
It's a great question. My grandfather at the earliest age. He was a farmer in Saskatchewan. He had to this day, probably the most amazing work ethic. He was one of the most, we believe when we talk about talent and character and integrity, the man had it in spades. And I actually, until the age of about 10, maybe 12, I actually wanted to be a farmer. That's how much I idolized him. And so sadly he's passed, but he was a great man and a great influence on my life. And I stand by him as my benchmark for character, integrity, work ethic, and what he instilled in me.
Amazing. I think your family owns some farms in Saskatchewan, right?
We do actually. So that's very, very beautiful.
Sadly, you know how it goes. Over time, the older generations, they retire and they pass on, and the next gens all kind of started to become in the city and doing those kinds of jobs and so on. So eventually it got sold, but it was so formative for me to grow up in Saskatchewan and to be exposed in a more middle-class setting to like a farming culture and so on. It was just fundamental to who I am today.
Incredible. I can relate. Next question. What is the #1 book you'd recommend?
Financial literacy focused?
Anything.
It's okay. Anything. Even though the questions are financial related, this is any book.
Even on the personal level,
Yes. I'm going to give you 2. And I am going to do one on financial literacy, and I'm going to do one on mindset. Okay. Financial literacy by far and I'm going to even qualify this. I did a finance degree at Dalhousie in Halifax, graduated in 1994. So in theory, I came out of university trained about like what we're talking about today. The reality is the training was completely wrong for like personal finance management and planning, which blows me away to this day. So when I tell you about this book, I actually do it with that caveat that this is a degreed individual. I've got a bachelor's of commerce with financial and finance as my major. And even I needed to learn. Wow. And so the book is called The Psychology of Money by a gentleman named Morgan Housel, Housel. There's also a free blog post that's very lengthy that talks about it. That was what created the inspiration for the book. This book probably came out a little over a year ago. It actually kind of culminates in my entire view of financial literacy, which the #1 issue in investing is behavior. Everything else can be taught: asset allocation, fees, security selection, taxes, all that stuff. The number one issue is how you behave when the chips are down. And let's use the example. .com 1.0. I'm a young guy building my wealth. The NASDAQ drops by 50 or 60%. Sorry, 80%. The S&P drops by 50%. What do you do the day after that?
Right.
How do you react to that? And the short on it is its behavior. And Housel wrote a book about this that I think everyone should either read the book or read the blog post. The second book that I recommend is on mindset. Okay. How do you understand that when things are stressors, when they're negatives, when they're crises, that there are various ways one can react? And the best way generally to react is in a way that seeks the opportunity within the crisis. And the book that kind of set the stage for this, there's a lot about resilience in this book and so on, is called Anti-Fragile: Things That Gain from Disorder, written by a very famous author named Nassim Nicholas Taleb, Taleb. I can't recommend that book enough around creating a mindset around understanding how to react better in stress and crisis.
And it's called Anti-Fragile. Right? It's
Anti-Fragile:
Right.
Things That Gain from Disorder.
Okay, very cool. All right, next question, Brice. If you had the opportunity to travel back in time, what advice would you give your younger self?
This is a perfect question. I did not understand literally the power of compounding. I would never want to relive my life. I'm blessed on all levels with a beautiful beautiful wife, beautiful, business building and I love everything about that. I actually would have told myself to get saving and compounding earlier. That is actually probably the most important thing that I missed as a youngster. Thankfully, I caught it up, but I would have started a lot earlier.
Nice, okay. All right, what's the best investment you've ever made?
So various ways of measuring return, but the largest dollar investment return that we've had is the wireless company that we started and sold 6 years ago. It was called Win Mobile. It's now called Freedom Mobile in Canada. And that was what really set us up with the liquidity to have our investment platform. So by that measure of size of dollar gain, that was the winner. Now, there are other measures, IRR, multiples, and so on, probably not the biggest, but it was the most impactful.
Okay, right on. Now, what's the worst investment you've ever made, and what lesson did you learn from it?
Yep, great question. So there are two ways I would answer this question. One is I've invested in a bunch of micro cap public stuff that's almost gone to zero. Why did I do it? I didn't follow my own rules. So the lesson is follow your rules. And I have a framework for investing, and then I get a call from someone that I know, and they're like, hey, you should buy this little stock here on a stock tip. Go buy this oil stock. And I go buy it and it goes to zero. And I do no due diligence and I just take the tip. So there's a whole category of investing that that's that behavioral thing again, where even when you have rules, someone calls you and you violate your own rules. Never violate your rules. Point one. The second way I would answer this is I've taken zeros on the venture and tech investing that I do when we come in very early. And the lesson there is very simple. You should expect to take zeros on those investments, or else you're not taking the right amount of risk in that asset category, because portfolio construction in venture requires a risk profile where some break out huge and some go to zero. And so I am okay with those zeros because it was part of a process.
Okay. Next question. How much would you need in the bank to retire today? What's your number?
Okay, so I'm past my number. If I wanted to meet my definition, freedom, control of time, burn rate cover with passive income, I'm past that number. For me, it's not a huge number because I live a reasonable lifestyle, so I don't need $100 million or anything like that. But here's what I would say to you is that you have to, whatever the definition of freedom and control of your time, you have to do things that drive you, get you up in the morning every day, keep you motivated, inspired, and charging forward and learning and growing. And so for me, it was very interesting. As we came out of the operating side, moved to the investing side, I actually found a whole new passion. I love what I do every day. I love meeting founders. I love mentoring. I love investing and so on. So again, that old cliche about you don't consider what you do a job is very true for me. And I keep doing this to keep the mind going. But what I have done is I've done a lot more impact related work, which is a product of having more time. And I've been able to do a few things that I wouldn't have been able to do as just a straight up operating person. So I'm at my number. And it's much more now about making choices about what one wants to do to be as smart and impacted and learning as possible.
That's incredible. Amazing. All right, next question. If you could have dinner with someone dead or alive, who would it be?
Yeah, that's a hard one because there's a lot of people in the category, and it would be dead because I would need to understand some of the fundamental historical truths and untruths. I'll pick one. Okay. Major religious figure. Let's pick Jesus Christ, but it could be others. I would want to understand what reality was there and what it wasn't, and really get a flavor for that. But there are lots of people in those categories that you have this manufactured construct, as they say, history is written by the victors. And I would want to really try to go below the surface and understand these big seminal moments with someone who's already passed. And there are many, but I'll pick one for that.
That's really, really good one. Next question. If you weren't doing what you're doing today, what would you be doing now?
Oh boy. Okay, I guess, 50, kind of have met my number and so on. Very hard for me, again, because I have control, to think of doing something else right now. But how I would maybe answer it is, the challenge for me ahead is, how do I keep myself engaged doing something different? As inevitably will happen, I'll want to slow down the work pace and kind of what I'm doing day to day, as I've mentioned. And so actually, you know what? It's a bit of a challenge. And it's something that guys like all of us who run pretty hard in what we do every day, there's a day where that slows. And the question becomes, is what does that look like the next day? And for me, I don't know the answer to that yet. Is it picking up something different? Would I want to be a prof talking about entrepreneurship at a college? That's not that far off from a lot of the mentorship and so on that I do. And I could just imagine if I did that, I get sucked right back into what I do every day. Do I want to, sail off into the sunset, move to a warm destination, pick up? I used to be in the Naval Reserve. Do I want to start sailing again and kind of living that lifestyle? Candidly, I don't know. And it's a very important question that I think about a lot right now as the next phases of life, come closer and closer. Excellent question. Don't have a great answer there.
All right. Well, this is my favorite question, the next one. Book smarts or street smarts?
Street smarts for sure, but I will caveat it. I encourage those who are more street smart than book smart to start to understand the concept of getting a little bit more book smart by looking at frameworks on how you do things. Okay, I'm a huge fan of Charlie Munger, Warren Buffett's business partner. You guys will know that name, of course. Munger has built this whole kind of philosophical thinking around the use of mental models to not have to learn everything from scratch. And what I would say to the street smart person is, good on you. You're lucky. You're street smart. You've kind of got that basic, but you need to back into some of the thinking of some of the best minds around mental models, frameworks, playbooks, and so on, to help you do things better, faster, stronger, and not make all the same mistakes that the person before you made. So I do caveat it.
And where would be a great place to reach some of those mental models? Is it through books that Charlie has authored, or what would be a...
Yeah, it's a great question. There is a book on him written by a gentleman named Trent Griffin called, I think it's actually called Charlie Munger or Munger. And it's actually, I didn't put this book out there for you guys, but it's an excellent book, partly because it has chapters that are unrelated solely to investing. It talks about the psychology of human misjudgment and a bunch of other important things in terms of the mind. But yeah, I think, honestly, there are a few books. I'd be happy to send a few to you if you post notes or anything like that talk about mental models. Actually, you know what? I'll give you a website. There is a group in Canada, actually, who are also Munger acolytes, disciples, called Farnham Street, Farnham, Farnham Street. Now, interestingly, Farnham Street is the street where the headquarters of Berkshire Hathaway are. And the guy's just a complete apostle of these guys. And he has created a business focused on kind of taking what Munger talked about and turning it into a business. And he has written 3 books on mental models. And he also has this incredible website and podcast that are all about learning from those who came before you to make you move faster, smarter, and stronger. And so Farnham Street website, blog, podcast, and these books that they've written on mental models.
Amazing.
Right on.
Thanks for that.
Perfect. Last question, Brice. Okay. If you had $1 million cash, if you had $1 million cash and you had to make one investment today, what would it be?
You know what? We are very concerned about valuation in general, almost across the board. We have seen what's happened over 2020 and 2021 in almost all asset categories, particularly in North America. Okay. So here's what I would say to you. We think about this every day because we have this challenge. Okay. And I'm gonna cut it in half. And I'm gonna put half of it in a non-North American market, equity market, which has very large pockets of value that I think over the next 20 years will have a lot of forces in its favor. And that market is China. And I would suggest the China A-share style of investment. So on the mainland, the Shanghai exchange type investing. And the reason I say that is twofold. Number one is China just recalibrated itself over 2021, where its market got hit. It took a lot of action against some very successful tech entrepreneurs, and it kind of scared everyone. And China does that every once in a while. That caused quite a downtick in the Chinese equity market and has created pockets of value. And we know the power of China over the next 20 years will continue. So I believe there's an interesting entry point into the Chinese equity market now, looking forward about 20 years. Keep that long-term thinking. The second half, I would probably put with a venture capital manager that I trust, that has proven themselves time again to be ahead of the curve on thesis and trend, and it gets me into the innovation economy and keeps me running with the smart intellectual property and intellectual kind of capital advances that are going to happen. So those would be my two for right now.
All
Amazing.
right.
Awesome.
Right
a bit
on.
more sophisticated that I would buy multifamily, which most of our guests would say.
Yeah, that's really cool, Brice.
Really appreciate that, Brice. Yeah.
Maybe you could just quickly tell people what is the best way that they can reach you.
Yeah, so I'm on LinkedIn. You see my spelling of my name, I think, in the corner. That's always the first hurdle to find me. So feel free to hit me on LinkedIn. And then the second way is I do a little bit of tweeting, not that much, but feel free to follow on Twitter. But the best way is definitely LinkedIn.
And we'll share that in the show notes. This is just in case our show turns into a podcast. Hey, Brice, really appreciate it. We'd love to have you on again at some point in the near future. Appreciate all the knowledge.
Yeah, and looking forward to your mentorship on my behalf. And thank you
got it.
So much.
All right, thank you. Really enjoyed it and hope there's some value there. And I look forward to the next time.
Awesome. Thanks, Brice.